A. Link performance measures to strategy, ensure timely feedback, and align with drivers. Performance measures must align with strategic and operational goals. Metrics should reflect what the organization is trying to achieve, such as cost leadership, differentiation, or growth. When measures are disconnected from strategy, managers may optimize local results that do not contribute to long-term success. Timely feedback supports corrective action. Delayed reporting reduces the ability to respond to operational issues or market changes. Real-time or frequent performance updates enable proactive management and continuous improvement. Measures should reflect cost and revenue drivers. Understanding underlying drivers ensures that metrics focus on controllable activities influencing outcomes, promoting accountability and effective resource allocation. B. Explain issues in determining product, business unit, and customer profitability. Cost measurement challenges affect profitability accuracy. Assigning direct costs is straightforward, but allocating indirect and common costs can distort product or customer profitability. Activity-based costing may improve precision. Allocation and investment measurement create complexity. Shared resources and joint costs must be allocated systematically. Measuring assets employed by business units affects return-based performance measures. Valuation assumptions influence analysis. Transfer pricing, inventory valuation, and depreciation methods impact reported profitability, requiring consistent and transparent accounting practices for meaningful evaluation. C. Calculate product line, business unit, and customer profitability. Product line profitability begins with contribution margin. Sales revenue minus variable costs determines the contribution margin, followed by deduction of traceable fixed costs to compute segment margin. Business unit profitability incorporates broader cost responsibility. It includes revenues, variable costs, and traceable fixed costs associated with that unit, sometimes extending to allocated shared costs for full evaluation. Customer profitability considers revenue and service costs. After subtracting product costs and customer-specific selling, distribution, and service expenses, managers can identify high and low-margin customer relationships. D. Evaluate customers and products using controllable margin and recommend actions. Controllable margin focuses on manager accountability. It subtracts controllable fixed costs from contribution margin, excluding common costs beyond managerial influence. This ensures fair evaluation of performance. Unprofitable segments require strategic assessment. Before discontinuing products or customers, managers should evaluate whether they contribute toward covering common fixed costs or provide strategic benefits. Improvement strategies enhance profitability. Options include price adjustments, cost reductions, service level modifications, product redesign, renegotiation of customer terms, or selective discontinuation when segments fail to meet performance thresholds. E. Define and calculate return on investment, ROI. ROI measures profitability relative to assets employed. It is calculated as operating income divided by average operating assets. The ratio indicates how efficiently a business unit uses its assets to generate profit and is commonly applied in investment center evaluation. ROI can be decomposed using the DuPont formula. ROI equals profit margin, operating income divided by sales, multiplied by asset turnover, sales divided by average operating assets. This breakdown identifies whether performance is driven by profitability or asset utilization efficiency. Clear definition of components ensures accuracy. Operating income excludes financing and tax effects, and operating assets typically include working capital and fixed assets used in operations. F. Analyze and interpret ROI calculations. Higher ROI indicates more efficient asset utilization. A rising ROI suggests improved profit margins, better asset turnover, or both. Managers analyze trends over time to assess operational effectiveness. ROI comparisons require consistent measurement. Differences in accounting policies or asset valuation can distort comparisons across divisions. Adjustments may be necessary for fair evaluation. ROI may create dysfunctional incentives. Managers might reject profitable investments if they lower current ROI, even when such projects exceed the company's cost of capital, potentially harming long-term value creation.